Most businesses don't fail because of bad products. They fail because of bad accounting. In this video, we'll break down the top 5 accounting mistakes that quietly bankrupt small businesses. If you are a startup founder, small business owner, or even a student of business, you need to understand how cash flow, budgeting, and financial statements can make or break your success.
Welcome to Accounting Media with Ian Obasi.
Here are the top accounting mistakes that can make a business fail. 1. Cash flow chaos. Sales are booming, but your cash flow is dying. That's a classic mistake. Without tracking when cash enters and leaves, even profitable businesses go bankrupt. Profit is not equal to cash. You could sell more on credit and still record profit at the end of the month, but in real sense, you do not have enough cash to run your business. Under accrual accounting, transactions are recorded when they occur, not necessarily when cash is received. If you do not keep cash flow statements for your business, it doesn't tell good of your business. In a nutshell, at least have record of cash inflows and outflows in that business. Number 2, break-even blind spot. Don't know your break-even point? You are basically flying blind. Break-even point is that point where cost is equal to profit. It's the number 1 figure you need to hit before your business makes a single dollar of profit. Knowing the break-even point helps the business determine when they will start generating profit. Without calculating fixed plus variable cost versus unit price, you may price too low to ever profit. 3. Misclassifying expenses. Mixing up personal and business expenses or misclassifying them can trigger tax audits, mislead investors, and ruin financial analysis. Believe me, you shouldn't mix your personal spendings with that of your business. That's poor accounting practice that could make that business to fail. Avoid it. Accurate expense categorization affects taxes, forecasting, and investor confidence. Number 4, revenue is not equal to profit. Let's say you made $50,000. Great. But if your cost is $100,000, you are losing money. Many businesses chase revenue and ignore margins. What are these margins? Gross profit margin and net profit margin. They measure the profitability and efficiency of that business. Track gross profit margin and net profit margin, not just revenue. Before we continue, just have a look at this.
Ever wondered what those profit margin numbers really mean? Gross profit margin is all about efficiency in making and selling products. The formula? Take gross profit, sales minus the cost of goods sold, then divide by sales revenue. Multiply by 100, and that's your gross profit margin percentage. It tells you how much money a company keeps from each dollar after covering direct costs. High gross margin? They're keeping more from every sale, a good sign. Now, net profit margin digs deeper. It's net profit, what's left after all expenses, including taxes and interest, divided by sales revenue times 100. This number shows the true bottom line. What percentage of sales actually becomes profit? If the net margin is low, even big sales might not mean big profits. In short, gross margin shows production efficiency. Net margin reveals overall profitability. Analyze both, and you'll spot strengths and red flags in any business.
Alright guys, finally number 5. No budget, no forecast equal to no future. Budgeting feels boring until you run out of cash. Budgeting is a financial plan outlining projected income and expenses. That's to say, you make estimates of your possible income and spendings and compare them to actual results at the end of the day. Forecast, on the other hand, helps you plan for slow seasons, tax payment, and growth opportunities. Forecasting is equal to business GPS. So if you do not make budgets and forecast, you wouldn't know if your business is doing well or not. Have a look at this.
If you don't like spreadsheets but still want to grow your business, then budgeting and forecasting are your new best friends. Imagine driving cross-country with no map or GPS. That's running a business without a budget or forecast. Budgeting is your roadmap. It sets your financial goals, shows what you can spend, and keeps surprises to a minimum. Forecasting. That's your weather report. It helps you predict bumps ahead, like seasonal dips, new hires, or a big marketing push. Together, they give you control. You'll spot problems before they grow, grab opportunities when they pop up, and sleep better at night knowing you're not flying blind. Start simple. List what's coming in and going out, then update it as you go. Bottom line, budgeting and forecasting aren't about limiting dreams, they're about making those dreams possible. So take the wheel, map your route, and drive your business to success.
Accounting doesn't have to be hard, but ignoring it is fatal. Like and subscribe if you want more business truths that actually help you succeed.